charts. And this session is a little different than most of the ones that we teach, whereas today we do have a few ideas that we want to make sure we impress upon you as we begin our session. But the majority of today's class will be dedicated to response to your comments, and specifically one type of comment. What we are going to do in this piecing it together class is talk about what types of indicators exist, show you at least one example of a chart with some reasonable indicators, but then we will spend the rest of the time analyzing your own chart setups. So go ahead and pull open that question and answer tool down at the bottom of the screen and send in to us what are the indicators, the time frames, things that you are looking at on your chart to help you make your buy or sell decisions. Go ahead and send those in to us in as much detail as you can, and we will be building those ourselves, Nick and myself in the background, in order to then talk through them. And then we will give you our thoughts, our open feedback on what's good about your current setup and what may be lacking, giving you some suggestions on things that you could consider adding or removing. As we walk through this, we're going to start off, as I mentioned, first with a quick example of what a chart might look like. So let me go ahead and pull up my screen for you, folks. And here, if we go ahead and do so, what you'll see is a chart, in this case of the S&P 500, and we have a few different ideas on hand. Number one, we've got a chart with the price of the S&P 500 going up and down over time. That's the red and green bars. We have several different moving averages ranging from a 5-period simple moving average to a 20 to a 50 to a 200-day simple moving average. Those are indications of trend along different time frames. We also have down at the bottom of my screen a measure of, right down here, a measure of momentum. This is the relative strength index, giving me some hints at what's happening in terms of changing environments. For example, the fact that yesterday we came down from above 70 down here to below 70 was a warning sign telling us positive momentum has waned. Maybe things are changing. We saw continuation of that today as we sold off and found ourselves back down here near that 20-day simple moving average. We also have a couple of other lines, these horizontal bars going across my screen. This is what's known as the price volume distribution and can be one way to visualize where trades have occurred in the time frame of your chart to give you an idea of potential areas of support or resistance that may show up on the chart over time. Finally, I've got this dotted line up here, which is a measure of volatility. This is the Bollinger Band and tells us how big the swings up or down have been relative to the simple moving average here. The 20 is the center of these Bollinger Bands, telling us a little bit about that. So this is one potential chart setup. That does not mean, even though it's the one I'm starting out with, that it is the right one, nor is it complete. For example, part of my own charting involves several different tabs. I have this one, which is almost entirely blank, save a few lines that I have hand drawn in. Here on this page, I can see the price a little more clearly. With all of those indicators on here, sometimes it's hard to see, or at least for the price to stand out to us. I like to also have a mostly blank chart so I can see the price. In addition to the daily scale, I want to zoom in and see something much shorter. In this case, I'm looking at a 2-day scale where each bar represents 5 minutes worth of activity. Very worthwhile, especially if I have a very short-term trade that I am considering during the course of this. So this would be a starting point where we could look at. But when we talk about these different types of indicators, the key that we should understand is twofold. Number one, we should remember that these indicators are calculations of the past. They are not predictions of the future. Hopefully, they give us some indication, hence the name indicator, of the present, what is existing currently. And then we can make our determination. But as all of them are based on this same price, the one that we can see very clearly on this chart, they're just slicing that up and serving it back up to us in a different fashion. As a result, folks, we should remember that none of these will tell the future. We should also remember that there is no right indicator, no golden indicator, no perfect indicator. Instead, folks, what we are looking to do is understand our chart a little bit more like the dashboard of a car. It's fine that some dashboards do show the voltometer, where it shows how charged up your battery, whereas in other cars, especially newer ones, it seems like they've chosen to leave that off. It's fine that some of them show you the tire pressure in your tires. But it would be strange for there to be 3 or 4 speedometers. If there were, that would be a waste of that valuable space used as the dashboard on the car. We want to make sure that in your own dashboard of a chart, that you are being efficient and using your space effectively so that you can get the most out of it. Speaking of dashboards, I have a brother who is a commercial airline pilot. And one time I had the privilege to go up with him in a little two-seater airplane. And as much as I like to think I'm a capable individual, as I tried to read the 100 or so gauges on his dashboard, I received no information from the airplane dashboard. Because there was so much there, I could see nothing. But to my brother's trained eye, those gave him enough information to help us safely navigate, communicate, and arrive to our destination. In the same way, folks, you should only add something to your dashboard if it adds value to you. More is not better. In fact, for me, it was decidedly worse to have more in that airplane cockpit, as I was unable to gain any value. Make sure when you add something to your chart, it's not because Nick showed it, not because Jake showed it, not because you heard about it on YouTube. No, this is because it answers a question that you need answered. And that's what we are looking at. So, folks, that's going to be our intent and plan for today. Nick, let me pass you the mic to introduce a few ideas in relation to the indicators and classes of indicators as you would like to lay out for us.
Sure, absolutely. And I want to set the ground a little bit with, just kind of a couple ideas that I have as well. And so I built out a kind of a quick chart. And what I've done is I've added some indicators to the chart. So first and foremost, we can see price at the very top, but then I've added 3 different momentum indicators. This kind of builds on what Jacob was saying, that we wouldn't want to see 3 different tachometers or 3 different speedometers on our car. Really only one is what we need. And sometimes it can be beneficial to have it in more than one spot. I've seen some really fancy cars that have the dial right by the steering wheel, and then some that might have a little heads-up display where you're looking up and it kind of reflects off the windshield, so you can be looking up and seeing how fast you're going. But we don't need 3 different dials, 3 different analog dials. We only really need one. And so as such, this kind of basic chart that I've set up, has some moving averages, it has some momentum indicators, but here we have slow stochastics, we have fast stochastics, we have Williams percent R. And there's some minor differences between them, but like, for example, if I were to modify this just a little bit on this low stochastic basis, and I'm change the smoothing coefficient from 3 to 1, drop that down, and would apply. You'll notice that now this starts to look a lot similar to this fast stochastics here. Stretch this up just a little bit, were near identical to this fast stochastics. In addition, if we come over here to Williams percent R and we add an indicator, and the indicator we add is we'll add an exponential moving average to it. And then this exponential moving average will modify it to then say, a 3-period exponential moving average on this would apply. And then you see we have the same ups and downs, same lines, same ups and downs, same lines, and we're effectively getting the same thing. Just there's a slight different coloration, so to speak, with this. And so is it valuable when really it comes down to, well, what actually pays you? Well, price is what pays, not what a momentum indicator is. And so, a lot of traders I've worked with that they've said, "Hey, Nick, I use A, B, C, D, E, F, G." It's like, let's remove some of these on here, because does the momentum indicator, does that tell you that you got in a good price or not? Well, we don't really know. It's up and down. It's range bound. It's from 0 to 100. And price isn't range bound. We'd like price to keep going up and up and up and up, so to speak. So with something like this, Williams percent R was designed for a specific scenario that if you look over here, this actually goes from -20 to -90 on here. That in essence, it's flipped. So some traders, they like to see it flipped to try and remove some biases on that. And just looking at the raw numbers with Williams percent R, it can take care of that for you to see it flip, because that could be beneficial. But just visually looking at it, it doesn't really help us. So we might go ahead and close out of this one and close out of fast stochastics, because we're able to achieve the same thing with slow stochastics, just changing the smoothing coefficient. Slow stochastics is a lot more modifiable than fast, because it does have that smoothing coefficient. You can turn slow stochastics into fast, but not vice versa, so to speak. Now we see a lot more with price. The other thing on this is I have both simple moving averages and exponential moving averages. And there have been studies done on, well, which is better? And those studies were really inconclusive. One wasn't inherently better than the other, though they have different pros and cons. Exponential moving averages tend to weigh more recent data more heavily than simple moving averages. A simple moving average, if you're looking at a 20 period, is going to weigh 20 days ago just as much as it weighs yesterday, for better or for worse. So what this might end up triggering is you might then have scenarios, you might have situations where you'll get a little bit of a quicker signal. And so we see this as a 20 period simple moving average and a 20 period exponential. I have a 50 period simple, 50 period exponential. And we see, well, this exponential drops down because it's reacting more to the more quicker data, comes back up. And so as we come back up into it, well, we actually got a buy signal right here a little bit sooner. Let me zoom in with this real quick. And we got that buy signal right here a little bit sooner, but what happened? Well, it broke back down. So you might get signals quicker, but you'll also get more false signals with that. That's kind of that trade-off with this. And so really, you don't necessarily want to mix sometimes. So you don't want to be using like a 20 period simple and a 50 period exponential. Typically traders will use just 20, 50, 100, 200, 5. They'll keep it all of one or all of the other, and they won't have them both on there at the same time. Now, I have seen traders that might use both, though not at the same time. They might have MACD, moving average convergence divergence, and then have those relevant exponential moving averages up on their chart. But then they shift to a different chart where they're not looking at MACD, that then might have simple moving averages and such. The big thing I want to iterate is it comes back to that price is what pays. So you don't want to be looking at something like this, because then all you see is the momentum indicator. You don't really see the price indicator. Just be mindful that when you start to add too many understudies to your chart, you also don't want it to get too busy. Then you miss everything. You miss the forest for the trees. And this goes back to what Jacob was saying on what are these indicators designed to show you? Well, they're calculations. A simple moving average is an average of price. So you can look at it and see, well, on average, prices are going up or going down, or we're still trading about where the average is. This can help you identify trend, because if on average price is increasing, well, what that might mean, we might be having on average higher highs, higher lows. We be in a uptrend. So with that, let me shift over a little bit. I had a couple charts that I wanted to share. I know Ray asked if we could take a look at some charts. Now, Ray, you had two comments on here. You also said a Bollinger Bands on balance volume. I'm not sure if you meant it on balance volume or if you meant it on price chart, but I built in something on this just in case. Now, I want to shift back over to this other chart that many of you in the audience have probably seen us use before, that does have that blend between, we have momentum indicators at the bottom, we have trend indicators at the top, using a 20, 50, 200, along with the 5, and then Bollinger Bands on this to see different time frames. Shorter time frames, like a 5 or a shorter time basis, longer for a longer term trend basis. And so with that, Ray, I'm sorry, on the price chart, I know you mentioned a 5, a 10, a 20, and a 50. And so you really have that focus on shorter term. Traders would utilize a 5, a 10, a 20 for shorter term, potentially even looking for crossovers. Now, there's not much from a longer term going beyond 50, and it could be beneficial to still keep that in mind. Now, that said, you could easily have another chart like this built over. You see, well, way above the 200, and then you kind of check that box. You don't always have to be focused on this, especially if you're a shorter term trader, because shorter term, you're looking at the next couple of days, next couple of weeks, but you still need to be cognizant of that next bigger term time frame. RSI can give you momentum basis, and it can be beneficial for things like this. Shift over, we had a time frame of lower highs while price was making higher highs. This is dealing with divergence. We had negative divergence on here, which this is typically a bearish signal with momentum. Now, on balance volume, it's used the same way, looking for divergences with this, but on balance volume, we were seeing higher highs until, let me draw this horizontal line right here, until this time frame right here, all the way through, and I'm going to draw this on the chart so we can see this. Early the chart peaked out right about there. But if you notice, we started to see that negative divergence as well with on balance volume. And so an on balance volume is also showing negative divergence. So is RSI. And then we get that confirmation where price drops below the 20, and then price drops below the 50 moving averages, showing us that short-term, intermediate-term trend are changing. Now, the other thing that we'll do is we'll have Bollinger Bands up on the price chart if that's what you meant, and this can also provide additional clarity on volatility, that we might see a little bit of a volatility squeeze like this right here, and then there'll be an explosion. There'll be a lot more movement. It could be up or down, and so we then see the squeeze and then pop up, and it rides the top, and the band got wider this time frame, and it's kind of starting to squeeze right here, and then it broke below, but then it did recover up like that. And so it could be also beneficial to have that volatility indicator on your price chart. So just a couple quick things I wanted to show that example Jacob, I know you mentioned you had a couple other charts built out. Let me turn it back over to you.
Excellent. Thanks, Nick. Yeah, folks, and there's still going to be time, I think, for even more. So go ahead and send in what else it is that's on your chart. We've got several of those of you who have already sent it in. Rest assured, we're going to work through them. Ray, I applaud Nick for everything he's already said about your setup here. I had built it out as well. You've got something covering the price. The price is still fairly visible on here. We've got trend. We've got volatility, we've got momentum, we've even got volume down here at the bottom. So you've got theoretically every gauge you could need on here. The question is whether the time frames are appropriate, like you pointed out, Nick. Maybe you favor a little bit more shorter term. That doesn't mean it's wrong, but now the question is there any benefit? But there's not an immediate gaping hole in what is being shown. So excellent example of what's happening on here. There was a request that we could show how to make those RSI lines have the red or green filling. We can do that by just coming over to the little key for RSI, give it a regular left click, and we find the ability to modify. By changing the opacity down here at the bottom, you're able to turn that up and it fills in anytime it passes your overbought or oversold level. In the case of the chart that Nick was showing for us, he had gone in and added RSI not just once, but more than once. When you go in and add it, it adds it right on top of the other. So now if we go back in and I change this, for example, to 60 and 40, we'll find that those lines have been adjusted now to 60 and 40, and you can see my pink and yellow lines were there. If I instead took the time to change that color to green, change this one to red, and turn on the opacity, we would start seeing that multi-shaded version that Nick had for us. So that's how you would go about it. Add more than one RSI if you like. Go ahead and fill them in using that opacity feature if you would like to do so. But on to the next chart. Alan, you sent in your ideas, and here's what we've got. Some of the similar trend here. In your case, you said you've got the 10, 20, 50, and 200-day simple moving averages. You also have Bollinger Bands. So all of those pretty similar. I won't spend too much time here. But next, you mentioned that you have volume on your chart, and that volume with an average of a 10-day average lined up on it. So I've got that filled in here for us. Then we have RSI making an appearance yet again. It's not the only momentum indicator. All of those that were showing duplication that Nick walked us through, the Williams percent R, stochastics, and several others, are also momentum indicators. But RSI is a commonly used one. It doesn't make it best. It does mean it's commonplace, popular. Next, down here at the bottom, you've got MACD, the moving average convergence divergence. What a mouthful, folks. No wonder people call it the MACD. The MACD is a set of lines down here at the bottom. And you might think of it as a series of differences. Specifically, this red line I'm hovering over right now is looking at how far apart two specific moving averages are. We could pretend like it's two of those that are on my chart up here, though in reality they are different lines. But it's watching how close together these are, and therefore observing when those two lines cross each other. When the red line is above zero, it means that the two lines are separate and the shorter term moving average is higher, meaning there is currently positive momentum. And when instead it gets below zero, that means there was a crossover of those moving averages, and now that shorter term moving average is below the longer term moving average. But then we try and smooth that out by adding a moving average to the difference between those other two moving averages. And that's what this green line is. It's smoothing out, trying to get an average between them. And then finally, the blue down here at the bottom is measuring how far apart green and red are. Anytime it goes below zero, hanging below this flat zero line, tells us red is below. That's our potential sell signal. Our buy signal is when red was below and then crosses back above. Additional strength is attributed to the indicator the further away from zero we are when you get that crossover occurring. That's a lot of things going on one indicator. And as a result, I will point out to you here, Alan, that you've got currently a lot going on your chart. It does depend on how large your screen is, but I would wager that you might be dedicating too much space to things besides the price. If you like all of these indicators and get value from all of these indicators, that is fine. But in my opinion, your price and price alone is getting obscured. I would encourage you to add an additional mostly blank chart that helps you to see the chart itself and see what that price is doing. Aside from that, all boxes are theoretically covered. As long as you're getting value from each of these, go ahead and do so. Alternatively, if you don't like having multiple tabs or multiple charts going on, you could certainly minimize some of these to maximize your space efficiency and then pop them open when you need to take a look at it and go ahead and close them down again when you've gotten the answers you need. But I would encourage you to give that question simply to see what's happening in terms of the overall value that you're getting from your indications. All right. The next one was more of a question, and this was, can I show how to get that price volume distribution to show up as an indicator? This one came from LJ, and thanks for asking. You can add this by coming up here to settings and then click the little checkbox here that says show the price volume distribution. If I uncheck the box, you see it disappears from the background. Adding it there is all it takes. You could also right click anywhere on the body of the chart, come to settings, and then you can choose to hide or show that price volume distribution. The other follow-on question was whether or not this is available on Chart Plus as well. It is, but the functionality there is a little different. What we see here is going to show us where the volume occurs for all of the time displayed on my chart. If I go ahead and change this, for example, from a 1 year now down to a 6-month chart, our lines look vastly different. If I zoom into just 1 month's worth, again, vastly different. If I go out to a 10-year view, well, suddenly our volume is very, very different. So all of this is looking at that on a relative basis over the course of the time frame displayed on the chart. If you use the version on Chart Plus, first I'll tell you, you're going to have to go to an indicator. It's an indicator there as opposed to simply under settings as an indicator, and the name of it is volume profile. And the volume profile requires you to click where you want it to start, and it will measure out the volume from that point forward as opposed to the total amount displayed on the chart. But it is available in both cases, both here and on the Chart Plus, which is the technology that runs the charts on Fidelity.com, for those of you who are curious. LJ, great question, and thank you for that one. Nick, if you've got another couple prepared, we'll go ahead and jump back over to you.
Sure, I'm just trying to build some of these up real quick. And there's a lot on Chart Plus you can share. Jacob, could you pull Chart Plus back up for us again real quick? I'm lagging, also trying to have a web page up. Now, we're asked about some other things like Dojin channel and such. Unfortunately, not available on Fidelity.com, but if you check out, on ActiveTrader Pro, but if you check out Chart Plus, some of those other features are there. I know we'd get questions on, Heikin-Ashi candles and such that are actually built into Chart Plus that weren't in ActiveTrader Pro. We had them in the previous Wealth Lab Pro, and I just could show us a little bit what has the indicators on there where it has some of those. You can always do the search aspect to see some of those different things. It's a little bit cumbersome when it comes to modifying indicators, adding several different types of indicators, but you can still add those all in there as well. So with that, Jacob, I'll go ahead and steal the screen real quick, but I just wanted you to show everyone again on that with Chart Plus building through. So we had a comment, of course, on this is from MT and such, and I was trying to build this out, still lagging a little bit. but you had a 20 period exponential moving average, a 50 period exponential moving average. You had this technical analysis tab up on here for patterns and events, in addition to MACD, volume, which you already have, and then also RSI. And I'm just going to select all on this real quick, apply that right there. And I was trying to add RSI on this as well, but you can see as we start to then add some of these indicators, we're getting less and less on visibility on price, and we can't see that as well. And like I mentioned before, price is what pays. Some of these start to become a little bit duplicative, repetitive. Many traders, when it comes to volume, just seeing volume is less informative for them. They like to see average volume, have a 20 period moving average on volume. They like to look at on balance volume as well to see, is there more volume on up days versus down days, to start to look at some of that divergence or convergence. You're using MACD, it's kind of the same thing. You're using the positive or negative divergence with that. Now, I do like, of course, that you're using exponential moving averages on trend along with MACD. I do think it's beneficial that if you're really using the MACD indicator, that you also have MACD on trend, on exponential on trend, because that's what they use. Now, utilizing something like MACD, which uses a 12 and a 26, but then only having a 20 and a 50 exponential up top, might be beneficial to have something that's a little bit shorter term, like a 10, or you could even actually add on the 12 and 26 EMAs and then have the 50 on top of that, so you're seeing some more of this basis. That said, MACD is a trend indicator, and having MACD and RSI, it can be a little bit duplicative, but it's not quite like having stochastics and RSI. Now, if you're using MACD as a momentum indicator, trying to see on how far up above the zero line it goes, is it going more up above the zero line versus just some of the crossover aspect, then it gets a little bit duplicated with that aspect. Now, where this technical analysis tab can be useful, where it might be a little bit better, is like what Jacob was saying, having multiple tabs up here, and then potentially on the other tab having technical analysis up here on the other tab. Because as we go back to this, I'll add this back on here, one of the big benefits of having this is looking down and being able to add it to your chart. And so we've applied this. We'll see all these things on a more recent basis. Let me shift this over to a 3-month basis. And we can see these bullish signals and these bearish signals. And this becomes a very informative tool to help from a learning perspective, where we might want to learn a little bit more on MACD, we might want to learn more on some of these other indicators. But if we're looking at this, we see, okay, commodity channel index, that's weekly, we're on a daily chart. Let's shift over and find one of these that's more on a daily basis. That's again weekly. Shift over, we have fast stochastics here. We can click on this and we can add to chart. This will pop up and this will add it to our chart, and it'll even draw a box around the bullish or bearish signal. Now, if you already have 5 different things below, well, what it's in drawing, it's kind of taking away. And so many traders find a better use having a cleaner chart with technical analysis than seeing this and then coming back over to their chart, where they then might have RSI already built in and be looking at that. Okay, we see RSI dropped below that oversold line, that 70 line. That's the bearish signal that it was drawing attention to. Or potentially looking at shifting around and going, well, I like what it's doing with the commodity channel index better, let me shift over to that, as opposed to having volume up on my chart, having something else up on my chart. Anything that you might want to add to this, Jacob, as we continue on?
No, I think that about does it. You're quite right. The technical analysis tab is great. I really love it for those of you who are trying to get familiar with and understand different technical indicators. If you're one of those who's saying, I think it was Jeff, you said that you're relatively new, I would encourage you to use this technical analysis tab there. So click on technical analysis at the top, and then you click to show those signals. That allows you to view any of those upcoming patterns and events, and can be a real valuable way for you to start understanding, oh, these are the types of signals that I would have seen if I was looking at it here or there. Then you can decide if any of those are the types that you need in order for you to add it to your chart. But notice how many are centered right there on the right-hand side. Suddenly we get a slew of indicators all telling us things, all at the same time, many of them giving the exact same signal. That's the concern with having too many indicators, is that we may be doubling up and then having 10 lights blaring at us instead of just one. Let's make sure we just listen to the signal that we receive as opposed to increasing all over. So, all right, let's go ahead and jump in. I've got a couple others put together here. Let's see. I think that didn't start quite right. There we are. Okay. Here we go. So next up on the list was VV. VV was wondering if we could please discuss a little bit this PPO indicator. The PPO indicator is one that measures the difference between exponential moving averages. And I'll show this here so that we can take a look at it based upon the question. So we've got a 20 and a 10 are the default settings for the price percentage oscillator, or the percentage price oscillator. And as we look, we would find if we were to go ahead and add a flat line here at 0, that anytime the blue, dark blue, crosses below the light blue, in other words, anytime our fast moving average goes from above to below, that also is precisely when we cross below 0. So this is already starting to point out some similarities to another indicator we just talked about. Do you remember which one it was? It was the moving average convergence divergence, the MACD. In fact, if I make an adjustment to our MACD and change its periods to be 10 and 20, if I also make a modification to make this white and this white for just a moment, suddenly we're presented with two lines that look more than suspiciously similar. Do you see the similarity on it? They move, in fact, in exact lockstep at all times. The only reason the two lines are different is that the percentage price oscillator measures in percentage, whereas MACD measures in dollar terms per share. So if we wanted to be able to compare this for Apple and see that it's at 2.4% on the PPO, and then come over and take a look at the S&P 500, which is at 5,000 instead of at 2,000, well, that's a very different look, isn't it? A very, very different look indeed. But 0.75 is a comparable number in terms of how far apart the moving averages are. When we look at Apple, $5 difference, 2.4%. So it's all about whether you prefer percentage or whether you prefer dollar terms. It also is relevant if we back this chart up to a long period.
Yes.
Now we're looking at a 10-year scale. I can't make anything heads or tails of this MACD over here to the left because it looks like just a tiny little squiggle. And the only relevant stuff is over here to the right. But when we look at it in percentage terms, it takes out the fact that the price has moved in huge quantities and therefore reevaluates. So PPO is simply a percentage version of the MACD. If you wanted to have your MACD type lines on the percentage price, you simply need to go ahead and add an indicator to it to go ahead and take a look at the simple an exponential moving average with a 9 period. And suddenly we've got effectively the exact same information from these two. If I go ahead and add this back on here as green, suddenly we see almost the same signals at almost the same time all the time. So make sure that you're not using both, but either of those could be useful. I prefer percentages when there's an option to do so, since it
Mhm.
simplifies some of that comparison and long-term charts.
Uh,
Next, oh, did you have
on
something to
the
add there, Nick?
yeah, still on this, Jake, could you go back to like a 5-year chart for us and take a look at Nvidia real quick, and we'll look at Nvidia and then also look at Tesla. Both these companies have had a really significant upward movement on this, and we can see on PPO the left half of the chart, at least on Nvidia, looked the same as the right half of the chart on PPO, where the left half of the chart on MACD, we're not seeing very much. And I think Tesla, you have to go back before that big pop and then the drop back off in 2022. So you might have to go back to that 10-year chart like you're looking at Apple. But, we see the full left-hand side that there's no information on price levels. But Tesla was still moving as much on a percentage basis as it is now. And so the PPO will show that to us on a percentage basis versus a raw price basis. And so over a longer term basis, this can be a little bit more beneficial to look at and to pull up. On a shorter term basis, you're looking at the last 6 months, the last 12 months, you're really going to see the same, they're going to look the same, so to speak. I just want to add that on there before we moved on from this.
Thanks. While we're talking about the comparison between different types of averages, let's go and address Michael's question. Is a simple moving average on an exponential chart equivalent to an exponential moving average on a non-exponential chart? I'm going to assume that when you say exponential chart, you're talking about adjusting this scale up and down the y-axis to be logarithmic, which you can do, folks, by right-clicking on the body of the chart, hitting settings, and then coming down here to the pricing axis, specifically to logarithmic, and it will change this to now squish in the values at the top to give us more of a percentage or exponential type view, as opposed to that straight linear value that we saw before, which kind of makes it hard to see any realistic value changes there in the beginning for Tesla or Nvidia or anything else that's had a substantial price move. But the answer to your question, Michael, is no, they are not equivalent. The exponential moving average and the simple moving average are simply different calculations. On the article labeled exponential moving average, you can find this, folks, by coming to settings, to help, learning center, technical indicator guide, help, learning center, technical indicator guide. And then I scrolled down and clicked on the article for exponential moving average. And here we can see this comparison between them. The values are simply different because they are averaging them out in a different way. A simple moving average of 3, 4, 5 is 4. It takes the average. But an exponential moving average of the series 3, 4, 5 would maybe be 4.6. It weights heavier the most recent value, and it forgets about the old value faster. And so you get a quicker following of the price with an exponential moving average, forgetting about the old values. That represents some benefits, specifically that it doesn't care so much about the oldest value, which is about to go away on a chart. That can be influential, but to answer your question directly, no, it definitely does not equivalate those two by changing your axis. However, there is a substantial difference that does come up as a result of changes in your chart. This question comes from MA. MA was wondering which indicators work better on an intraday candle or chart. I'll tell you that all of them function in the same way as they did previously, but as soon as we shift our focus from daily or longer into shorter terms, there are a few hurdles that we should be aware of and consider. For example, if we take a look here at this chart, now that I've got a 200, a 50, a 20, and a 5-period simple moving average on the chart, it looks like the lowest of them is the 200, and it's at 238. But all of the others are clustered right around here at about $250 per share. But if I change my scale to be looking at a daily version again, suddenly only one of them is near 250. The 200, which was at 238 or so, is now at 205. The 50 is down here at 196. They're dramatically different. That's because the indicator is calculated based upon the visual criteria. So in this case, we're looking at the closing value of each day is what's being used to calculate the average, whether that was exponential or whether that was the simple moving average as I'm displaying currently. But on the previous chart, where I was looking at it on a 30-minute per candle basis, now we're averaging out 200 30-minute candles. Now, I don't find a frequent occurrence where I need to think about the 200-day moving average of the 30-minute candles. So some probably are simply not going to make it into your consideration. But also we should be aware that there are some strange things going on when we deal with intraday candles. Specifically, that from this green candle to this green candle, the amount of time that passed was 30 minutes. And from this green candle to this one, 30 minutes and 30 minutes and 30 minutes and so on and so forth. But between this red candle and this one, it was the end of the day on July 12th to the beginning of the day on Monday. This was an entire weekend and from evening to morning. So it's not quite a fair comparison to look at the directional movement from here to here in the same way as we might look at it from here to here. So anytime we move to an intraday scale, we should be a little bit cautious in the amount of value that we attribute to any of these indicators when they span a dramatic gap. What I like to ask myself as far as whether this is useful to me is, what does this indicator even tell me? It gives me, if I'm looking at this red line, the 20-period average of the last 20 half-hour candles. Do I want to know the average of the last 20 candles? That's going to be a few here, most of these here, and maybe some from Thursday of last week. Is that what I want? Is that what I consider average or normal? If so, it is answering that question. But if instead you're trying to understand how is today's morning activity reacting, you might want to forget about this 20. It might be too long, believe it or not. 20 of these might be too much information. And instead, we might favor a shorter term moving average, more closely hugged and focused on the current price, as opposed to weighting in any of these others. We could also benefit ourselves a little bit by taking into account an exponential moving average. But this does give us an opportunity to look at this big difference in price and talk just a little bit about what's happening here on the moving average. Notice how the 5 moving average is going up, 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 up. Meanwhile, the price, yes, went up right here, but then started going down, down, down. So why is the moving average going up? Because this is averaging out this one and this one and this one along with these two, right? These 5. But at this spot right here, it's averaging out these 4 and this guy.
Yeah.
By eliminating this guy and replacing it with this one, the moving average increases because of the drop-off effect of that oldest value. Since there was a dramatic change during the lifespan of that moving average, the elimination of the old value is just as important, or more in this case, to the actual current value. This is a situation where maybe you would favor a different version of a moving average.
Yeah.
Or we could change our scale. If you're looking at the intraday values, maybe you don't want to look at a 30-minute chart. Maybe you zoom in even further. And now we look at a 5-minute chart. In this case, now we're only looking at about 2 days worth of information. My moving averages have been recalculated based on the 5-minute candles. And now 5-period moving average is only 25 minutes worth. This is the most recent action. And you can see that, yes, the price did appear today to be reflecting an importance to this 5-period moving average. Anytime it tried to flatten out or move higher, this was a relevant value. Even the 20 could have told us pretty clearly when it started going down. Yeah, there's a downward trend in play here in the short term. 20 of these 5-minute candles in play. So be aware that usually if you're trading on an intraday basis, the indicators that you're going to rely on will also favor that intraday basis on the candlesticks that you're looking at. But that does not mean that that's the only relevant way to look at this. For example, if we go ahead and take a look at the S&P 500, unless something has changed, and it looks like it has in the midst of our class, but let's take a look here at first the daily scale. And notice for me, folks, where our 20-day simple moving average is hovering. 5,540 or so, 55.40. If I zoom that back in and take a look at it on our 5-minute scale and drop in a horizontal line at 55.40, wouldn't you know it? The price came down and down and down until it didn't. And where did it stop? But, well, right here near that 20-day simple moving average on a daily basis. So we should be aware of indicators on larger time frames, even if you're using an intraday scale, and vice versa, by the way. But nonetheless, the indicators that are drawn and visualized on your actual chart should likely rely on only the time frame that doesn't gap from yesterday to today or other substantial differences, unless you're willing to account for that difference at least mentally as you watch for this drop-off effect occurring. Take a look at it again over here. Same way, but now in a negative direction. High values getting dropped off. These are tanking during that time frame. Not necessarily because the action was going down, but mostly because old high values were getting dropped out of the calculation. All right. Yeah, Nick, go ahead.
A couple of quick things I want to add in there, Jacob. And we also haven't gotten a lot of additional charts coming in. So please let us know if there's other things you'd like us to look at from a charting perspective so we can keep building these out, keep talking about these particular charts. A little bit of an extreme example, I pull up the filters tool and looked at today's biggest dollar gainers. You look at Chewy, CHUY, and we get asked kind of which indicators work better on the intraday basis. This kind of builds into that, and we can see a lot of things are kind of wonky on this. And if you could take a look at the 2-day chart for us. Sorry, CHUY, not CHWY. How useful are those moving average indicators on this particular chart? And you can very, very easily see when they dropped off. And so as such, in the meantime, when you don't have 5 bars worth of information, this could be where a exponential moving average could come into play. And if you could add in real quick for us a 20-period exponential moving average, just so we can kind of see that kind of comparison between the 20-period EMA and the 20-period SMA. You see it's a little bit more curved on there compared to that red one, where it kind of curves up. And so this is some of the pros and cons, that it weighs that more recent data more, and so adjusts back up. But even after 20 days, 25 days, 30 days later, there's still some residual backup in there where the SMA, it's not been 20 days, it's not part of the calculation. So again, pros and cons to using this. And this is also why that quicker reactiveness, why many traders trading on an intraday basis might tend more towards something that reacts quicker, like an EMA versus an SMA. But this is a great example of where you might actually want to look at, a 1-minute bar for that first little bit, or even change it to looking at the intraday basis, also looking at extended hours to maybe get some price prints, at 8:15, 8:20, before the market opens to see if it might also adjust your chart up there to have more data to look at. But I thought this was just an extreme example on which you were addressing there, Jacob.
Yeah, an excellent way to take a look at that. So you can see how much smoother this exponential moving average kind of tries to take care of that drop off effect. In this case, here is the 20 and here is the 20. So the red and this dark blue line are the two that are each equivocating these two. So the drop-off effect is narrowed down, but exponential moving averages actually don't calculate based on 20 days. They use an exponential factor related to the number 20 in their value, and that's why it doesn't peak right on up here and only focus on these until much later on. So interesting stuff if you're interested in the math behind it. All right, let's see. We had just a couple other questions. Sachin was wondering, for intraday, how many charts should you build? For example, a 3-minute, 5-minute, 30-minute. I'll tell you what I tend to do. I tend to have a 6-month long chart on a daily basis. I'm sorry, let me start with the oldest. I start with a 2-year chart on a weekly basis, a 6-month chart on a daily basis, a 1-month chart on a 30-minute basis, a 2-day chart with a 5-minute basis, and a 1-day chart with a 1-minute basis. And I'm flipping between them at different points to add lines from one to the other, look for relevant ideas, and may spend, in those cases, a chart like that helps me when I'm trying to trade extremely short term. We're talking 10 or 20 minutes is too long in the trade. Very, very short term, in which case the 1-minute chart is driving some of those original decisions. But the 5-minute chart's helping me slow down just a little bit, zoomed out to the 30-minute. Okay. Oh, all right. Maybe all is well. There is still an uptrend here. And zooming out to the daily to find things like we saw today on the S&P 500, where it stopped going down right near that 20-day simple moving average. There is no right. There is no wrong. Your goal is to make sure that you're getting enough information that you can make a wise decision,
Yeah.
but not so much that you can't make a decision. Remember me sitting in the cockpit of my brother's plane. I couldn't make any useful decision. And thank goodness we didn't rely on my skills. But for my brother, all of those were helpful. So you add whatever is helpful and eliminate the rest. For me, I just wanted to know how far away is the ground. That's what I needed to know, right? You answer for yourself what is valuable to you in your style of trading and what you can comprehend simultaneously.
To add on there real quick, I know a kind of a common thing that we'll see that Jess does in our options in the money sessions that we partner with Options Play is she typically looks at a longer period basis, a 3-year chart versus a 2-year weekly, and she'll utilize a 13, 26, and 40 week simple moving average because that correlates with 13, 26, 1 quarter, 2 quarters, 40, kind of rounding to 3 quarters. So you might have one chart like that where you're using something like a 13, 26, and 40, where the time frames on your averages are a little bit different, as opposed to using a 20, 50, 200 simple that just that quickly shifts back and forth. Now, that said, on a chart like what Jacob was saying, where Jacob uses a 5-minute chart and a 1-minute chart, he might have the exact same indicators on his 1-minute chart as he does on his 5-minute chart, but then he just changes his frequency. You can go down and you can click on 2 days, 5 days. If you click on 5 days, it will take you from a 1-minute basis to a 5-minute basis, but you'll use the same indicators on that. Where if you're looking at a weekly chart, you might have a little bit of a different look because you're looking at broader pictures on that, or you might want to base it on, quarterly earnings reports and such. And so there could be a benefit to having some different charts up there, some different tabs, because your indicators might change a little bit between, 3-year weekly and intraday. But if you're looking at 30 minutes versus 5 minutes versus 1 minute, you might be keeping the same indicators on that particular chart. You might just be changing your frequency. So I thought that add that in there, Jacob, to kind of elaborate more for our audience.
Folks, I can't believe it, but we already are right here at time. So let me go ahead and just wrap up this last question. Robin, you were saying that you would like to know how you would identify stocks for leaps using some of these indicators. A leap, folks, is a long-term ex, uh, anticipatory node. So it's a long expiration. It's just an option, but it's got a longer than normal expiration time frame. And so, Robin, if you're looking at relatively long-term options, you're going to use all of the same things, and you're probably going to be using a relatively long-term chart. You could trade leaps using them simply as a way to access leverage in some degree and trade exactly like you would the stock. But you do need to be
Mhm.
mindful that there is still time value, volatility concerns that tie in with this, and you should
Yeah.
probably consider those as well as what we've already discussed in terms of the stock and stock alone. Anytime you cross from stock to option, remember you add both time and implied volatility potential to the things that can help or harm your trade over time. So with that, folks, we're going to go ahead and wrap it up. Thank you very much for joining with us. For those of you who are brave enough to go ahead and send in your own chart setups, I hope we weren't too harsh. You seem to have really decent grasp of what you're looking at. Overall, thank you for your time. We appreciate the opportunity to share some of our insight with you. We've got a couple other things coming up throughout the duration of the week, but it's already getting late into the day Thursday. I'm looking forward to the weekend here, Nick. Few more hours and we're ready to go. Any other final thoughts for the folks?
We did get a couple questions near the beginning of the class on kind of where to start learning about technical analysis. And this is news and research, the top of the page, and then learn. You look over here at events on the left-hand side, our strategy desk, classes versus coaching. You likely joined this through the coaching link, through coaching and then technical analysis. We have a full week-long class on technical analysis that we'll step everyone through the basics. We'll talk about Dow theory and importance of trend and theory behind trend and such. And we really don't hit hard on indicators until the third week. And we do then have where we spend about an hour on the 4 different types of indicators and such. But then from there, once you have that basis, then our coaching sessions really shine. We'll have an hour session just on trend or just on momentum or just on volume and volatility and such. We'll take what we covered in an hour and expand it out to 4 hours. And then we'll have other sessions like this where we kind of build upon those that foundation that was laid by those previous classes. So I just wanted to share this as an additional place on where to learn more for those in the audience that would like to learn more.
All right,
Take care,
everybody.
everyone.
With that, we'll go ahead and wrap up. Thanks so much for joining with us. We'll see you back here again soon. If you're interested in continuing your knowledge or seeing some of this in place using charts live, right now, 30 minutes from now, the bell closes. We'll see how that ends up for the S&P 500 as it has continued to sell off a bit during the course of today's session. Folks, you want to understand why and where and what's happening next, please join us for the afternoon market briefing. You can find it just at the same spots Nick showed you, fidelity.com/coaching. Today might be a more worthwhile than normal, given the volatility we're witnessing in the market. So I hope nobody's been too scared out by it, but we'll see you here in a few minutes. Take care.